Consumer prices slowed last month, suggesting inflation may be cooling down. The Consumer Price Index increased 7.7% from October 21 to October 22. That's the lowest rate of inflation since January. Wall Street enjoyed that news, rallying on Thursday. All three major indexes recorded their best day since 2020. The Dow closed up 1,200 points, the Nasdaq 760 points, and the S&P 500 up more than 200 points. To explain all of this to me, I am joined by Lori Bettinger. She is the president of BancAlliance, a network of community banks. Lori is also the former director of the Troubled Asset Relief Program, known as TARP to you and me, at the Treasury Department. So, Lori, I'd like to know two things. What do you see in these numbers about what has happened? And then what conclusions, if any, do you draw about what might happen in the future about prices?
First, I'd like to say I think this report was a really pleasant surprise, right? We were expecting and hoping that inflation would start to slow. But, this beat expectations. Although I think it's important to say, right, we're still seeing inflation. It's just increasing at a slower pace. But, particularly you hear sometimes people talk about the core inflation measure, which is excluding food and energy, which tend to move around a lot. Admittedly, I think they all affect us a lot. We see gas prices, we buy food. But when you looked at that core, it really, there again, you saw improvements. So I think that there are good signs here that maybe some of these price increasing pressures that we've seen for so long are starting to soften. And I think you saw the market react to that because everyone talks about, hey, can we start to slow the economy without bringing it to a huge halt?
So when we say elements of inflation are softening, what goes down can go up again, of course. And there has been a lot of worry about the stickiness of some components, housing and other things. On the other hand, we've been in a situation where the Fed has been raising rates and raising rates and raising rates. So do you have any feeling about whether, basically whether the stock market has the right reaction? Because it sounds like the market's thinking, well, maybe this means we've turned a corner. Are traders being overly optimistic?
Well, I don't think I would ever want to be in a position of, perfectly predicting the stock market. But I do think we've seen this time and time again. Everyone's looking for optimistic news, right? You want to take a positive read on this. And I think it was like one good month and you felt this sigh of relief where everyone thought, hey, maybe this means that the Fed doesn't have to go quite as hard. But then we saw the Fed saying, hang on there. 1 month, it's nice to see some progress, but there's still really inflation across so many sectors that affect us. And 1 month is not going to change our minds. Maybe, we can be a little less severe, but I think you saw a lot of, different Fed people associated with the Fed speaking up this afternoon, really trying to talk about their resolve to take difficult measures to fight inflation. So I think 1 month, as you pointed out, it's hard to call it a trend that's going to last.
And if the Fed has resolve, that resolve will have economic effects on growth and on employment. What is your sense of what people can expect? I mean, everything from layoffs to hiring freezes to smaller pay. Help people understand what the future might look like in terms of the effects of this Federal Reserve resolve.
Of course, we've been hearing about and seeing a really strong job market. Even today, Thursday is when these first-time unemployment claims come out. They were up a small amount, but, this sort of 4-year average still holding steady. But time and time again, when you increase rates, and particularly you make it more expensive for businesses to borrow money to grow, I think we will see, maybe more layoffs. I know we're hearing about them now in the tech sector, but maybe in other areas of the economy. And I just think we're going to see a big slowing of job growth because what the Fed is trying to do is slow down the economy and make it, less desirable to spend, for companies to spend, for consumers to spend. And if consumers are buying less goods or services, right, companies need to produce fewer. So I think we'll see the job market slow. But so far, it's remained really strong. And I'm not sure, we're going to see sort of a huge spike in unemployment, but we could see a gradual increase, which, impacts those families clearly.
Lori, just quickly before you go, the Fed's target is 2% inflation. Is that realistic in this world now?
I hope it's realistic. I think that, I have a question of how long will it take to get there? And, we've had sort of these so many years of, a lot of stability in pricing. And maybe we're just in a different, more volatile environment right now. And, we say 2%, maybe, in a year or two, people will say it needs to be a little bit higher. But I think, right now the Fed has been consistent. That's what they're trying to hit. And all of their actions seem to be directed towards that target.
That's right. They're not budging an inch. Lori Bettinger, thank you so much for being with us.
Thank you.